Hey, what's up everybody? Welcome back to Investing Sucks. So today we're going to be doing a video on REITs, so real estate investment trusts. Specifically, we're going to talk about why you should consider REITs as an investment and how to kind of tell if one REIT is better than another REIT. And also I'm going to talk about how I personally decide to invest in REITs. So this video is going to assume that you already have a rudimentary understanding of REITs. So for example, you know what a dividend yield is, you understand what REITs are and how they're different from individual stocks, but maybe you're not really sure what role REITs can potentially play in an investment portfolio and if they're actually worth devoting your precious time into. Now, what I will say straight off the bat is this video is probably going to be pretty boring. It's not the type of video that's meant to entertain people because it is very technical. I'm going to talk about accounting. I'm going to talk about financial statements. So if you came to YouTube looking for some amazing type of entertainment, and this is probably not the video for you, go watch CoffeeZilla or go watch Strongman Personal Finance or anyone else who is good at entertaining people on the topic of finance. This video is going to be pretty technical, and I'm going to explain, like I said, my thoughts and also, just some basic facts about REITs that you should take into consideration when you're looking at them. So without further ado, let's actually jump into the video now. So some of you watching this may be wondering, why even bother with REITs? Really, what's the point? What's the added benefit you get with REITs as opposed to investing in just traditional equities? Well, a big thing that many people point out is that they've actually outperformed equities, so the S&P 500, over the long term. So there is many different time periods presented here, and it shows the average compound annual return. So what you'll notice is going from 1972 to 2019, they outperformed by a little bit over 1%. So that is, when you add that up over this long a time period, that's actually a pretty substantial change in wealth. And then over the last 25 years, not as much of an outperformance, but still a little bit. Over the last 20 years, much higher outperformance. And then in kind of the most recent years, so the last 5 years, they've actually underperformed. So it's not like the empirical data says that REITs have always been better. They go through these cycles where one is better and then equities outperform, REITs outperform, you get the idea. But what you'll also notice is a few specific sectors within the REIT sector that have done extremely well. So if we go down here, we could look at these REIT subgroups and look at the average annual return from 1994 to 2019, and we can see self-storage really stands out. I mean, 16.7 average return annualized for that long, that's a very strong return. And another one that kind of stood out is industrial REITs. So right here, we can see 14.1%. And if we scroll down, they'll actually talk about the reasons why that is. So they talk about self-storage REITs, which says one of the reasons why this one did so well was kind of just the nature of it. It doesn't really require that many operating costs. It has low construction costs. So that makes it more profitable at lower occupancy rates. And occupancy rates is really the key driver of demand. And REITs, like just normal businesses, need strong demand in order to increase in value, essentially. So high occupant rates can signal that there is pretty strong demand there. So then another one was industrial REITs, which also beat the S&P 500 over that time period. And the article cites this outperformance due to the growth in e-commerce. So with more people shopping online, industrial REITs, especially those focused on logistics properties, they've expanded rapidly. And when there's that demand for expansion, you're going to see higher occupancy rates, which ultimately leads to better rents and a stronger performance overall for the REIT, because you need people paying their rent in order for the REIT to stay alive, essentially. And then if we scroll down, we can see some other newer subsectors. So data centers is one which started getting tracked in 2015. And the return since 2015 has been 17.3% annualized each year. So that is a very good return. And the reason why that is, it cites, is just the increase in the need for data storage, essentially, because data growth has exploded, especially in the most recent years. A lot of businesses are moving online, and the world is becoming increasingly digitized, which means the demand for data center storage is going to increase. So you can kind of get a common theme from these. You can see what tends to lead to certain REITs outperforming and doing better than others, because what REIT success really comes down to is, can they keep their occupancy rates high enough to continue to pay out those dividends and not have to cut their dividend? And can they actually grow their asset base in a sustainable way, right? To increase the amount of dividends that they can pay by acquiring new properties, which then increase the rent they can receive. But they don't want to do that so aggressively, for example, by taking on so much debt that if there is some sort of decline in the industry, then they won't be able to meet their basic interest payments and they're basically going to go under. So occupancy rates are obviously very important to look at. And next, what I kind of want to go into is talk about the income statement side of the REIT and also the balance sheet side. So you need to understand both those things. And on my channel, I don't really look at balance sheet that much, but it is extremely important to look at with REITs because you need to understand how they're financing these properties, because REITs can only pay out 90% of the income they receive, or they have to pay out 90% to their shareholders, right? So they can't expand the REITs by just retaining the cash flow that they receive and using that to acquire new properties. The only way they can do that is by raising capital either through debt or equity. So if they're taking on a lot of debt, then that does increase the risk. So I'll talk about that in a bit, but first I want to talk about the income statement. Okay, so what you're looking at here is your standard REIT income statement for Canadian REITs specifically. So I'm going to use SmartCentres as the example company here. This is actually a REIT that I currently own, and I'll talk a little bit later about why I decided to buy them and what my reasoning for that was. So make sure you stick around and listen to that. But this is your standard REIT income statement. You can see up here, we've got the rental income that they receive. So just under 800 million. This is in Canadian dollars. So this obviously ties into the occupancy rates that we've talked about a lot now. Then they have their property costs, so the direct costs that go into maintaining those properties. And then there's various other items down here. Now, one thing you might notice is that their rental income, so just under 800 million, is actually lower than their net income, which doesn't really seem to make sense because you'd have to deduct costs from that. So it doesn't really make sense to say that revenue is higher than income. But if we look at it, we can see the reason why that is because of this item here, the fair value adjustment on revaluation of investment properties. So a lot of technical jargon there. So I do apologize in advance. We have to discuss accounting in order to understand what this is. And accounting really is the most boring topic known to mankind. But if you do want to understand REITs, you do have to understand this concept. So why we're kind of seeing that is because of the revaluation gain and loss. So when a REIT holds an investment property, they are required by accounting standards to measure it at its fair value. So the value that the investment property would have if it were to be sold on the active market. And that gets recorded on the income statement. So if the properties that they own increase in value, and they revalue them and say, okay, based on comparable sales of properties and transactions, this is what we estimate the properties to be worth. So they do their own assessment of that. And then they compare that to what it's valued on their books, and then they increase it by that value. So that increase is recorded as a gain here. So if you were to be looking at the income statement number and thinking this is the number that is used to pay out the dividends, then that would be incorrect because it includes this number here, this revaluation gain, which, as we've just established, it's not actual cash that they received. What is cash they received is this here, the rental income minus the direct costs. So this item here, it's not cash, it's just an increase in the value. So that's why you can't look at net income or earnings when you're looking at REITs. It's a totally misguided metric. What you have to look at is something called FFO, or funds from operations. So I'm going to show you how to calculate that now. But first, one other thing I want to point out is a key item on the income statement that you may notice is missing, and that's tax expense. So another thing you have to understand about REITs is that they don't actually pay tax. In Canada, they're exempt from tax. They get taxed in the hands of the actual shareholders, the unit holders. So that's a whole other topic that I'm not going to go into because the taxation of REITs is pretty complex. And although I am an accountant, not a CPA yet, but will be a CPA in a few years, I'm not a tax expert, and obviously I don't want to give out tax advice on YouTube. So definitely look into that further and speak to an actual professional if you want to learn about that. Okay, so here is a reconciliation of SmartCentres net income, so what we just saw on their income statement, to FFO, or funds from operations, which is really the metric that you want to use to gauge how much cash they actually have available to distribute as dividends. And as we've already established, they are required by law to distribute about 90% of the cash that they generate from the rental operations, less their direct expenses, to their shareholders. So it's a pretty simple calculation, really. We have the net income here. We take out that fair value adjustment on the investment properties. We also take out the fair value adjustment on financial instruments, which they use financial instruments to manage risk, I'd assume. And then we also take out the any sort of gain or loss they have on the sale of their investments, because again, this is really just an accounting calculation. So that gives us funds from operations. Now, what most people will actually use to evaluate the REIT's cash generation abilities is AFFO, or adjusted funds from operations. And in simple terms, all AFFO is you just take FFO and then you deduct capital expenditures, which are certain items that the REIT has to spend as just general upkeep on their properties to make sure that they're running smoothly, as well as something called rental straight lines, which rental straight lines really just refers to rental income that the company has recorded as revenue, but they actually haven't received it in cash yet. And remember, the whole point of this is to capture how much actual cash is the REIT generating that can then be distributed. So that's kind of why that gets taken out. They're both pretty small amounts in the case of SmartCentres, so it really doesn't change things very much. And then I sort of did my own calculation here, just kind of as a reasonability check. So this was the amount of dividends that they paid in all of 2021. And we can see it's about 89% of AFFO. So pretty much on par with what we'd expect there in the 90% requirement. Now, one last thing I want to talk about in regards to FFO and AFFO here before I move on to the balance sheet side is just that these metrics are not defined specifically by accounting standards. Companies can choose to report these in any way they want. So there is some room for manipulation in these numbers, but keep in mind, most of the time, you're not going to have to worry about actual manipulation happening, because it is in the REIT's best interest to report these numbers accurately and actually maintain investor confidence, because if there was no investor confidence, then people wouldn't invest in their REITs and they would basically be done after that. So that is something to keep in mind, that you are going to see some variance in between different REITs on how they calculate FFO and AFFO. So just keep that in mind going forward. Okay, so now we'll move on to the balance sheet. So a few notable items to look at on the balance sheet are obviously right off the bat, the value of their investment properties. So for SmartCentres, it's just under 10 billion in total value. And you can see there is a note here, which actually will provide you a reconciliation of the change in this account. So the change in 2020, when it was just under 9 billion to just under 10 billion. So they do provide that information. And then you can also look at the liability side. So they keep it pretty simple here. They have debt as well as some payables. And then there's the current portion of the debt, which is in current liability. So this is the portion of the debt that's due within 1 year, while all of this debt here is due from 1+ years, so either 1 to 25 years or however long that the debt is outstanding. And one interesting thing about SmartCentres is, so their equity, which is total assets minus total liabilities, is 5.8 billion. And if we look at the actual market cap, it's 4.6 billion here. So there is actually a discrepancy between the book value, which, keep in mind, a big part of the book value is the value of these investment properties, which are always going to be measured at the most recent fair value, or what's their best estimate of the most recent fair value. So it does appear, based on that alone, that you could conclude that the SmartCentres REIT is slightly undervalued just on book value alone. However, it's not always that simple to just look at book value, because there are going to be discrepancies. Say if the REIT was to actually liquidate and sell all their assets, what they would actually get for it versus what's just reported here. So just because you see a REIT that's trading for below its book value doesn't mean you should instantly jump in and try and buy it. There is nuance there. So in addition to that, we also established how REITs can kind of expand, right? So because they have to pay 90% of the cash flow they generate to their investors, they can't expand organically just by retaining that cash flow and using that to buy properties. They have to do it either by issuing equity or issuing debt. So because of that, it's very important to understand the breakdown between their capital structure, between how much is debt versus how much is equity. So a common metric that people use to evaluate that is what's called leverage. So all leverage means is the extent to which a REIT has financed their property acquisitions with debt versus with equity, because equity is generally considered a little bit lower risk, although it can be more expensive because they're typically required to, pay out whatever the dividend yield is, which can be in the range of 5 to 6%, which is higher than interest rates, especially lately, where As we'll see, their interest rates that they have on their debt are kind of in the range of 3.5%. But overall, generally speaking, debt is going to be more risky because if the company has a lot of debt, obviously they have to make interest or mortgage payments on that debt. And if for whatever reason, say there's a slowdown in the economy, or in the case of SmartCentres, a lot of their REITs are retail locations. If their tenants start going bankrupt and they can't continue making their rent payments because they're not meeting certain sales targets, and overall things are going bad in the economy, that could spell trouble for REITs. And you are going to see that reflected in the dividend yield. So a higher dividend yield, say it's in the range of 10%, that means a lot more risk. So there's a reason that the dividend yield is going to be 10%. That doesn't automatically mean that it's undervalued. Maybe investors are thinking there's a likelihood that that dividend yield could decrease because the tenants are going to stop paying their rent and they're going to receive less cash flow as a result of that. So then they'll have to lower the dividend that they pay to their unit holders. And then, so if you look at, say, like a data center REIT, which would have a much more safe form of cash flow because maybe they're locking their tenants into long-term contracts and those tenants aren't really going to move because it's tough to move your data center operations. Those are typically going to have a lower yield. So you can kind of understand the difference between risk and return, which is obviously crucial to any sort of investing you're doing when it comes to REITs specifically. But let's now take a bit of a deeper dive into the concept of leverage and look at it for SmartCentres. Okay, so we're going to go back into Excel. I'm just going to show you some super basic calculation that I did to get an understanding of what the leverage is like for a REIT. So we can see all I really did was take total liabilities, total equity, which were found on the balance sheet, add them together, and then see the percentage that make up that total. So for liabilities, it's 48%, and for equity, it's 52%. So what I've personally noticed is with REITs, they're typically going to be in the 50-50 range or slightly below, where liabilities make up a lower percentage than equity. So that is generally seen as rather conservative. I believe with private REITs, you might see more aggressive use of debt or liabilities because they are trying to expand. But with public REITs, so REITs that you can just buy on regular markets, because they're subject to so much more scrutiny just by typical investors and investment analysts out there, they're probably going to be a little bit more conservative in how they use debt. And if they can use equity to raise capital to fund the expansion and purchase new properties, then they are going to take it, but they're also going to take advantage of debt because debt has been pretty cheap for a long time. Interest rates have been low. And just to give you an idea of that, the secured debt, so they have secured debt and unsecured debt. Secured debt meaning it's secured with collateral, which means when they go to the bank or whoever they're trying to get the debt from and get the financing from, they will also have an asset that they provide as collateral. In the event that they can no longer repay that loan, then the bank can take possession of that asset. So that asset could be a property, for example, it could be one of their retail locations or a building that they have. So that's why it's called secured debt, because in the event of default, it's secured by that asset. The bank can take possession and they can sell the asset to retain some of the funds that they may have lost by making that loan and by them not being able to pay it anymore. Unsecured debt means it's just the company's promise to repay. There's no actual asset backing up that loan. But what was interesting to me is that the secured debt actually had a higher interest rate than the unsecured debt, which usually that's going to be the opposite. Usually the unsecured debt, because there's more risk, because there's no collateral, is going to have a higher interest rate, but not the case here. And what I want to do next is go back into their financial statements and show you a bit more in depth on how you can get a good understanding of a company's debt, because it is obviously crucial to understand for REITs, because you have to know how are they financing these properties. Okay, so I've gone to note 12 of their most recent financial statements. So as of year end, December 31st, 2021. So you can see the breakdown in debt. So I always want to understand with a REIT, how are they financing their properties? What type of debt are they using? So we can see they're using secured debt, which we already talked about what that is. Unsecured debt, which is 3.2 billion. So the vast majority is unsecured debt. And then revolving operating facilities. So that would just be kind of agreements they have with the people lending them money, where they have some predefined limit and they can borrow up to that limit, pay it down and borrow back just kind of as they want. So if we take a look at the secured debt here, we can see right off the bat, they tell us weighted average interest rate of 3.49%. Now, what I'd also want to understand is the breakdown of that debt between what is a variable interest rate debt and what's fixed interest rate, because variable interest rates, they're dependent on whatever, they have, or they describe it here, the banker's acceptance rate plus 120 or 170 basis points. So if this rate were to increase in the future, then their interest rate is going to increase, which means their interest expense goes up and their ability to generate cash to pay out as dividends goes down. So you have to understand the breakdown between variable interest rates and fixed interest rates, because that will tell you what sort of interest rate risk does this REIT have. So with this one here, it seems like the vast majority is fixed. So they could say it includes 1.1 billion out of the 1.3 billion at fixed interest rates, and then this amount here, so 70 million at variable interest rates. So with their secured debt, there is less interest rate risk because most of it is fixed. Now, if we scroll down and look at the unsecured debt, they actually provide an entire schedule of these different tranches of debt they have, as well as the interest rate that's attached to it. I don't think they mentioned here whether it was fixed or variable, which I thought was kind of weird because they did mention it up here, but they do tell us that the weighted average interest rate is 3.17% as of this date here. And then if we keep scrolling down, we can see they talk about their revolving operating facilities. So this is a much lower portion, but you still do want to understand it. So they say they have 500,000 in unsecured revolving operating facility, which has a variable interest rate at either bank prime rate plus 20 basis points, or again, the banker's acceptance rate plus 120 basis points. So this is another example of variable interest rates. So there's a bit more interest rate risk with this one because, again, if rates increase, that'll increase their interest expense, which lowers the amount that they can pay out as dividends. But overall, this is a pretty small amount. And you can see there is some interest rate risk in their debt portfolio, but nothing really too concerning. Nothing that strikes me as particularly concerning or really bad. So no real concerns here. And then something else you can also look at, which most of the time they will have as part of their debt schedule here, would be their credit rating. So they do receive credit ratings. So you can see they talk about it here. Now they say an investment grade credit rating must exceed BB, with the highest rating being AAA. So AAA would be, like the government, right? The best credit rating you can get. And their credit rating services refer to them as BBB. So that is investment grade. So the professionals have basically said that BBB, high credit rating, so they do have strong credit standing. And if you're wondering how the credit scale works, it would be B, and then BB would be higher than just B, and then triple B would be higher than BB, and then it would go single A, double A, triple A. So triple A would be the highest. Okay, so now I want to talk about why I personally decided to buy SmartCentres REIT. So what I saw in them. So, and really I can do this quite simply. This is going to be one of the more simpler investments that I can explain to you guys, because it's really only going to take 2 charts to explain it. So what you're looking at here is the price to book value of SmartCentres. Now I purchased it, I believe around April of 2020. And as we can see here, due to that thing that happened in early 2020, their price to book value absolutely plummeted. It went down very drastically here. It even got as low as under half of their reported book value, which would be their assets minus their liabilities, which is interesting because we know that they always measure their investment properties at their fair value, or their estimated fair value. So when I saw this and I saw kind of what it was trading at, such a low book value multiple, it seemed that it was priced as if no one was ever going to step foot in any of their tenants' properties again. And, the thing was, there was a lot of fear priced in, I'll put it that way. And if you believed that the lockdowns were something that was temporary and eventually things would get back together, then there was a pretty substantial opportunity for these things to converge, which we can see they since have done that. Now it's come down a bit since, I guess, back in November of 2021, when it was back to trading above its book value per share. But overall, that multiple has converged quite a lot. It's now at 0.94. And when I bought it, I believe I didn't buy it quite at the low. I think it was around 0.6 when I bought it. And then by extension of that, the dividend yield, so if we go to this, is also going to be much higher. So I'll extend this back. And again, we can see that spike here. So the dividend yield spiked because the price just dropped, right? There was a huge sell-off that occurred. So I believe I bought around this time. I believe it was about a 10% yield when I got it. And to me, the ability to lock in a 10% yield in perpetuity on a REIT like this, which seemed pretty strong and resilient, like we just showed with the balance sheet, it didn't have too much debt on its balance sheet. So a 10% yield, I thought, would be safe going into the future. And what's interesting to see is if we extend this way back, you can see it was even higher during the, I guess, 2009, so shortly after the financial crisis. So it is good to monitor these dividend yields because for the most part, it's kind of been trading at that 6-5% range, which at its current levels, at only a 6% dividend yield, that's not really that attractive. I think you can get a better yield than that just by investing in equities. So, but what I saw before at the 10% yield, to me, that was much more intriguing. And based on what I understood, just on a rudimentary analysis of the REIT, it probably wasn't going to completely collapse. So that yield would be safe and I'd be able to collect 10% in perpetuity. So that was kind of my thinking around this. Again, that's my personal opinion. You don't have to agree with that or invest that way, but I just wanted to share that with you guys in case you did find it interesting. Okay, so now let's conclude what we've discussed. So clearly with REITs, there is definitely some opportunities out there to earn some decent returns. As we saw from a historical perspective, they've done pretty well. Some of them have even outperformed equities, which is interesting to know. But personally, I think one of the reasons of this outperformance may have been exacerbated by the very low interest rates we've had. And one of the reasons why I think this is with this example that I'm going to show here. So it's kind of how REITs can create value. So step one in this value creation process would be borrow at about a 3.5 interest rate. So as we saw with SmartCentres, that's about what interest rate they have. Then go and try and find a property with a yield that's higher than that. So say an 8 to 10% yield. And then you would basically profit the difference between the interest you pay and the yield you receive. So let's say a company purchases a property that's worth 100 million. So it has an 8% yield. So they're receiving 8 million in rental income per year. Interest expense on the loan with 3.5% interest would be 3.5 million. You then deduct other operating expenses that they may have, like just general upkeep. And then your profit from that would be 2.5 million. And then you pay out 90% to investors, and you can basically create this new cash flow that you can distribute essentially out of thin air, right? Because you received financing, use that financing to buy the property, and the property just started earning cash from you straight away. So if these interest rates were to increase, then that's going to cut into the profit. And we talked about that before with interest rate risk. So that's one thing that I personally see as kind of having an influence on the REIT industry as a whole. Obviously, everyone's going to have different opinions on just what they see happening in the sector. Personally, I don't think that REITs are an absolute essential to have in your portfolio. If you do understand them and you see a certain opportunity in a REIT, then yeah, as we've seen, you can definitely make some very decent returns investing in REITs, but don't think that you have to have a REIT in your portfolio. It doesn't offer some very special form of diversification because generally they are kind of correlated with the economy as a whole. So yeah, that's just my opinion on the matter. And that pretty much does it for this video, guys. So thank you so much for sticking around and listening to my analysis. I hope you did find it useful. If you did, then please leave a like and subscribe if you're new to the channel and you enjoy this type of content and these kind of deep dives into different things about finance and investing. And with that in mind, I'll see you in the next video.